Hi, my name is Roy Rumbo, and I am an adjunct accounting professor at the University of North Texas. I started teaching in 2017 when I took early retirement from Linux International, where I was the chief accounting officer, corporate controller. I had that role for 11 years. Prior to that, I spent 17 years with Maytag Corporation. There, I worked in internal audit, financial planning and analysis. I was the VP, CFO of a division up in Burlington, Vermont, and Maytag was located in Iowa. And I got promoted to be the corporate controller, chief accounting officer for Maytag in 2002. So, and I had that role for 4 years. Maytag got sold to Whirlpool. So I've had the opportunity to experience all areas of accounting except income tax. I'm not a tax person, as the VPs of tax in both companies always tried to make sure I knew that I was not a tax person, even though from time to time I had a position, an opinion about the taxes. So that, again, why am I teaching? I just wanted to give back to the profession. It wasn't really about making money. And I really enjoyed it. I was a full-time professor for 3.5 years. And along the way, I told the chair, I'm thinking about retiring again, and spending some time on the beach. I love the beach. And he said, wow, Roy, why don't you just take some of these courses you're teaching and put them online? And I told him at the time, this is probably 2019, no way, I am never teaching online. I enjoy the face-to-face interaction with students. That was cool for me. Well, that was really good answer until March of 2020 when COVID hit. We had about 2 weeks, maybe even a week to take, and I had about 400 students at the time. And I had to take all of them. I had 4 courses and I had to take them all online. I had to figure it out. I had never heard of Zoom in my life. And suddenly I was doing Zoom lectures. At that time, I didn't know much about how to handle Zoom or anything else, but I had done some YouTube videos with my son in the past. And so I recorded and downloaded all the lectures I did for Principles of Accounting. And it was Intermediate Accounting 2 at that time I was teaching, and download those to YouTube for my students. And that was the only purpose of it. But yet those videos have been out there now for a couple of years. And I have, 100 plus subscribers. I'm definitely not going to be a YouTube star or anything like that. But that's the source of where all these videos that I have posted to YouTube has come from. Now, again, all the way to 2022, the chair asked me to teach Intermediate Accounting 1 as an adjunct, just one class. And I said yes. It's a lot of work to develop a new course. But in the process of doing that, I did create online lectures using Zoom, and I downloaded those to YouTube. So those lectures are now all out there. So right now, and it's a big hodgepodge of videos if you look at it, and I wish there was a better way to organize those on YouTube. I've not been able to figure that out. And I don't know if you can put YouTube videos in folders or different things, but I have an entire Principles of Accounting course, every lecture for that course on YouTube. And now I have all of Intermediate Accounting 1 and all of Intermediate Accounting 2 on YouTube. I will, just to give you a heads up, those lectures for Intermediate Accounting 2 are going to be different because I was just learning how to do things, and those were created in the midst of COVID. So you may hear on those videos me encouraging my students to hang in there and to figure out the materials. And I may be giving some information about the upcoming exams and things like that. But the meat of the materials are still there. And again, I've had quite a few comments from people all over the world. I had someone respond the other day from New Zealand. I didn't know. I don't know how they found my lectures, and I'm not advertising. I have no desire to be a YouTube star, and I doubt you could be teaching accounting. But anyway, if my primary purpose is for my UNT students, but if these lectures help anybody out there, that's why I'm doing this. And so if you do, by happenstance, run across my videos, hopefully you watch this introductory video to all my videos. And my videos are organized according to the chapters in the McGraw-Hill textbook we use. And I do, and I want to give credit to the publisher here, I used the McGraw-Hill textbook. It's the name of it is Intermediate Accounting, and it's by Spiceland, Nelson, and Thomas. It is a great textbook. I love it, and I will just continue to plug it. I think I plug it in every lecture and trying to give credit to McGraw-Hill for such a great textbook. And I want to do that right now, even though none of the materials are here. So I have 2 lectures for every chapter except the first chapter. And the first lecture, at the end of the title, I even use the word lecture, like accounts receivable, cash and accounts receivable lecture. And the second lecture, and this is exactly what I do in my classroom, I work problems. And I think more of the students who watch these videos like to look at the problems because I try to continue to teach as I work the problems. And maybe these are problems that you might see as someone watching these YouTube videos in your own class. And so I always say in those videos where I work the problems, pause the video where I have the problem on screen, work the problem yourself, and then watch me work it. So with that, I think hopefully all these videos will be helpful. And the last thing I'm doing here on this lecture is this is a presentation I did for myself. I use this in my accounting career, by the way, to try to talk to people about what accounting was about. And so I did a lot of, even as a chief accounting officer, I found as my accounting and finance roles, and especially in the executive and leadership roles, I was always having to educate people about how accounting worked. And then usually why their budgets got hit with these big expenses, or we like to say charges, is why are you charging me that? And I'd have to explain pension accounting or various different rules. Remember having to explain to the CEO share-based accounting and how there were changes in share-based. So if you want to be an accounting professional and executive, education has to be part of your role. Now, I will note here, I do have on here my email address. And if you are watching this and if you're watching my videos, certainly, I don't know if I'll ever re-record all these again, but this is my email address. Man, I welcome you. Again, my name is Roy, last name is Rumbo. There's the spelling there. I welcome you to reach out to me and give me any feedback, or just I'd love to connect and understand who's watching my videos. I do really enjoy mentoring students and around accounting careers, do a lot of that. And so if you have questions about accounting careers, email me. Maybe I'll even do a Zoom session with you and give you some counseling or whatever around accounting. Nothing. I wouldn't have I have my own problems. I couldn't solve your problems, but I certainly would be willing to help you with accounting if you ever wanted to reach out to me. I also encourage you to reach out. Hey, connect with me on LinkedIn. So there's my name, and I, just acknowledge that you've been watching my courses. So, and by the way, this is a mountain here in Texas, in the Guadalupe Mountains National Park in West Texas. And so you see how beautiful this is. I think this is called Hunter's Peak. And I personally took this picture from Guadalupe Peak across the way. And so it's the highest mountain in Texas. Who knew Texas even had mountains? And so that's a great place. Now, I did just Photoshop that eagle in there. There's not an eagle flying. I wish I had got that picture like that, only because the UNT is our mascot's the eagles. And so I use a lot of eagles in my classroom. So with that, I'm going to just jump into kind of an overview of accounting just briefly here. I give this overview for my principles of accounting students, but I start my intermediate accounting course with this too, just to keep people level set, And so kind of this presentation here is what is accounting. And we're going to go through the business cycle, look at all the things we have to, get cash in the form of ownership interest, the company receiving cash, or we have to borrow money through debt. By the way, every company, we need more than cash. We got to have ideas that can be turned into commercial products. Then with great ideas, we can sell this commercial enterprise to people like on Shark Tank or whatever, and give people an ownership interest in, or even maybe go to the bank and try to borrow money. After that, we're going to recruit and pay people. We're going to pay facilities. If they're a manufacturing company, we're going to produce inventory. We got to pay for that inventory. Hopefully we bought it on terms. We got to sell the inventory. By the way, we don't get paid right up front. We have to give people terms. And so we have this account called accounts receivable, where we sell it, where people are going to pay for it later. And, and by the way, down here, we may have accounts payable. We buy the inventory. Always think you see the word payable around anything, that's a liability, or salaries payable, things like that. And so, if we're successful here all along the way, we're going to collect that accounts receivable, and now we've come full circle, and now we have cash. And if we're really good, hopefully we generate a positive cash flow that, in the cash flow statement, we call it cash flow from operations here, as we do this and generate cash. And that cash can be used to go invest in the business, maybe buy more facilities if we're very successful. That would be an investment section of the cash flow, just to help you think about that. Or we certainly got to pay our interest. If we don't pay the interest on the debt, guess what? Game over, bankruptcy. And so we're going to have to pay interest to our debt holders. We don't have a choice there. We could also, we do have a choice, pay dividends back to our equity holders. And so, and what we retain of the earnings and the cash, which is called retained earnings, we could use that again to invest in the business. And this process is just ongoing at Lennox International and both of Maytag, very global companies. Lennox, we had cash in about 20 to 25 different currencies around the world. So think about that. This thing is running full blast. By the way, yes, Thanksgiving's a holiday in the United States, but not in China, New Zealand, Australia, Mideast, Europe. And so it's a very global company. This thing is running full blast all the way around. And here in accounting, we have got to somehow take a periodic snapshot, and we've got to measure the results because people are very interested. Two big questions, which we'll get into here even in this presentation. Number one, is this company making money? And we got to find a way to measure that and to report out yes or no. The company is making money or losing money. Second is, what's the financial status of the company? Second question is this company going to survive? Is this company in the future going to generate enough cash to pay dividends and to grow for the equity holders and to pay back debt? And so what's the financial, second question, what's the financial status of this company? Especially from a liquidity standpoint. Liquidity means ability to generate cash. Solvency is another important word, for accountants. Solvency means ability to pay back the debt. The company is insolvent. That's another word for bankruptcy. So we want to be able to ascertain the solvency of this company in the future. So what is accounting? Well, number one thing I tell my students, okay, this is not a math course. I've had so many really super smart students in my office during office hours saying, I am failing your course. By the way, you're the problem. Sometimes they do want to blame the teacher, but they knew, most of my students knew that I really cared and I was really trying hard, even though I may not be the best teacher. And I had to explain to them, it's not a math course. Because many times they would say, man, I've made straight A's in math in high school and in college. I'm an expert at calculus, A+, but I'm not getting this. I'm struggling with accounting. Well, it's not a math. It's a measurement system with a lot of logic. And there's a lot of rules in how we, 1 + 1 = 2. It depends, because we got to look at the rules to see if 1 + 1 will equal 2, or whether we'll even recognize either the one or the second one. So number one is a measurement system. Definitely not complicated math, which is good for me. I love that. In fact, one of my students once told me, and he was he was trying hard. I was giving him a hard time because I didn't think he was born for an A. And, he told me after I spent a lot of time in my office and I helped him. He told me once in class, he said, well, Professor Roy, if you can figure this out, I know I can. So I thought that was a great statement. I said, yes, I am no rocket scientist. I'm not the smartest guy in the room, and I figured this stuff out. So yes, any person can figure this out. but it may take some time. It may take the ability to think about things a little differently in terms of a logic. So we're going to measure things. We're going to measure business transactions. So first and foremost, it's a measurement system. Secondly, it's also, after we measure, we got to report out. We got to tell people, are we making money? What's the financial, what's the financial status of the company? Does it have the resources and the cash to continue operating? And we're going to report to a lot of various and sundry interested parties, creditors who've loaned us money. By the way, maybe prospective employees. I wouldn't go work at a company without looking at the financials. I want to see the financials if I'm going to work there. Now, a lot of private companies might not share those with you. And so you got to question yourself about their transparency because, first of all, you are going to look great when you say, yes, I love this company. I've had great interviews with everyone, but I'd like to understand more about the financial status of the company. Could you share your financials with me? Where can I see those? And I may have some questions about them. Wow, that's the kind of person businesses want to have. And so this reporting system, again, many and a sundry kind of interested parties. Maybe the US government, the IRS, they might be interested in those financials. So we're going to be reporting out what we measure. And we're going to talk about how do we measure. So first, what is it that we measure? Well, we measure assets, liabilities, and equity. What are assets? It's just the things we own. Buildings, we don't own our employees, so there's no asset. That's our employees are assets, but we don't measure them. We pay them and we record expense, but there's no asset. These are things, not all of them that we touch and feel, because I can't touch and feel accounts receivable, but that's very much a right to collect money. And so these are the things the company owns: cash, accounts receivable, inventory, buildings. So all the things we own. What are liabilities? Hey, that's amount we owe other companies, people. We may owe our vendors, that's accounts payable. We may owe our employees because guess what? No company pays you every hour you work, every day you work. Usually you finish a week or a month and you get paid the 1 or 2 weeks later. I'm sure many of you experience that in your job. So companies have a liability to their employees who worked and have not got paid yet. And we call that salaries payable. We may provide our customers with warranty on their, when you buy a vehicle, you get a warranty payable. So we may owe future service work on the products that we have sold to companies. Debt, we may have borrowed money from a bank. We may issue public bonds. That's another form of debt. And so again, these are all liabilities, things we own. By the way, if you cannot pay your liabilities, you're not solvent. You're bankrupt. Game over. And so this is a really big deal. When you look at the financial statements and what we report, we're going to be looking, users of those financial statements, be looking at these liabilities. Now, assets, less all the things we own, minus the liabilities, the leftover piece, that's equity. That's our owner's interest in the company. And the company gets not only, let's say they invest in the company, provide money, and they receive back common stock or some form of equity ownership. And so first part of equity is the ownership's what we call paid in capital. But guess what? The liability owners, we got to pay them back what we owe. If the company makes a lot of money, we just pay back what we owe. But if we make a lot of money, that's the owner's piece. That's why they're in the game. They're investing in the company because they're expecting the company to grow, to be profitable, and that their great interest is in their share of the income of the company. And they can get a return on their investment through dividends, which are paid back from time to time at the choice of the company. Or some companies don't mind, and investors don't mind. Hey, don't give us dividends. Keep investing, keep growing. Amazon has never, ever paid a dividend. They started with CDs or books. I can't remember which was first. And they took all the money they made from CDs and they grew their business and started selling books. And then they would move. I can't remember what they did next, but now there's almost nothing that you cannot buy from Amazon. I bought some Ethernet cables today from Amazon. Going to be delivered, ordered them at 10 o'clock to be delivered at 2 this afternoon. So they also invested in systems, in ways, and now even they have their own delivery trucks. So instead of paying dividends, they've never paid a dividend. How do the owners win? Well, the Amazon stock, because of all that growth, has gone, it's grown outrageously over time. And so that's what we call capital gains. So the value of those ownership interests in Amazon have grown greatly, even though they've never paid a dividend. Now, owners also have a right to influence and even help make decisions of the company. For large public companies, every year there's a shareholder vote, on who can be a member of the board of directors. The board of directors are 10 or 12 people for most companies that have fiduciary responsibilities to our interests as owners. They make decisions for the company, like even important decisions like who's going to be the CEO. They have to fire the CEO, and the board of directors is standing in line there. And so we do have owners do have ability to influence and make decisions about the company. Therefore, a lot of new companies, small companies, they would much rather borrow money than to sell an ownership interest. Once you sell an ownership interest, you're going to lose some control over your company because the new owner is getting into your business. They may have differences of opinion than you have. So again, just trying to get to what these things are. One other thing I want to say, all the things, I want you to think about it another way. All the things we own, that's the total of all the assets we own. That's great. Liabilities and equity, they're the claims against what we as a company own. So we always say the big accounting equation, assets equal liabilities plus owner's equity. That's the super duper accounting equation that everyone does remember from their courses. And so all the things we own equal all the claims against what we own. It's just that simple. Now, how do we measure? Okay, a carpenter, he uses inches and feet. In pharmacies, they probably look at liquids and, gallons or whatever. There's always a way to measure stuff. If you've done like your science project for your class, there's a lot of measurements that you take and you learn all of that, in your science classes. Well, we don't use inches or feet. I would almost say we do use dollars or some type of currency, but our main tool for measuring things are debits and credits. And so, by the way, debits comes from, I believe it's a Latin word. All it means is left. And credit comes from a word that means right. So a debit or a credit by itself doesn't mean good or bad. It depends on where it might be on the financial statement. Credits on the income statement will be gains, income. So in that sense, they're good. The credits on the balance sheet, as we're going to see, are liabilities, amounts we owe. Now, how do we get to this? Debits on the left, credits on the right. Well, the normal balance for assets is debits because assets are usually, on the left side. All the things we own, we'll see a balance sheet here in a minute. Everything we own on the left side, those are assets. And so a debit, if we record a debit into an asset account, it's to increase the dollar balance of that asset account. On the opposite side, a credit will decrease that balance. So we will, even though the total balance for almost all asset accounts are debit balances, we may put those credits in their time to reduce those. That's just a part of the measurement system. Now, the normal balance for liabilities and owner equity, they're on the right side, all the claims against the asset. Assets, things we on the left side, we'll see a balance sheet in a minute. And the right side are all the claims. Those are credits, right side of the balance sheet. And so just like debits increase assets, credits increase liabilities or equity. And a debit decreases the liability or equity. And it all stays in sync. By the way, and I would skip right to here, total debits always equal total credits. We're going to make sure that happens. Why? Because always, always total assets equal total liabilities plus owner's equity. Again, all the things we own equals all the claims against what we own. How do we keep debits and credits equal? By the way, as long as total debits in our accounting system equal total credits, this equation is going to stay true. So therefore, again, we are not rocket scientists as accountants. Someone that was smarter than us created this debit and credit system. And so whenever we record a debit, we have to record a credit. So it's kind of dual entry. And so if we increase an asset with a debit, then we also have to record a credit somewhere. And that credit may reduce a different asset, or it may create a liability. An example would be, let's buy inventory. Debit the inventory account, and let's say we buy it on terms, credit accounts payable. And so we've increased with the debit the inventory, that we own this inventory now, but we haven't paid for it yet, so we have an accounts payable, a liability. Let's look at another example. Let's say we buy inventory and we pay cash for it. So we're going to debit inventory and increase the inventory account. We're going to put a credit in the cash. And so in all those situations, if we increase one asset account and decrease another asset account, hey, total assets haven't changed. If inventory goes up and accounts payable goes up by exactly the same amount, that means total assets have gone up, but total liabilities have gone up by the same amount. And by keeping total debits equal total credits, we stay in sync. So whenever we have a debit, we also have a credit. And so that's what's called a journal entry. When we record a debit, until we'll have a debit and the name of the account and amount, we'll have a credit, a different name of a different account and an amount. And so that is how we measure with debits and credits. And this is why we use debits and credits. It's idiot proof. And I need that. Maybe you're like me. One good thing about accounting is it is kind of, it seems intimidating, but after you understand it, it's like riding a bicycle. You won't forget it. You'll get it down. And so, but it's still intimidating to other people. So guess what? You can make money, and we have a lot of certifications in accounting. I'm a certified public accountant and I'm a certified management accountant. And so that when you have those certifications, that communicates to the world that you have expertise, you know what? You can make money, and it's good. All companies need accountants. Guess what? Governments need accountants. Non-for-profits need accountants. School systems need accountants. So and it's a growing demand today, because people are saying these accounting numbers are so important. And why are they important? Because we are the guys and gals with the numbers, and we report out the numbers, and people care. People in the business care about these numbers, maybe for their bonuses because they're paid on income. They care and investors in the company really care. People who've loaned money to the company, they care. A lot of interest. And so the accounting profession is a growing profession. And so it's a good place to be. So you're taking intermediate accounting, you must be down that path. And for finance professionals, same thing. That's a growing area, but you need to understand financial statements and how they work. So here's the financial statements. How do we report? Income statement. That's just what we sell minus the expenses to sell that stuff. So if we had to buy products, those would be what we call cost of goods sold, an expense, and we'd have a revenue selling that product. And so is a company making money? As long as we're selling more and at a higher price than what we're paying for and buying, we make money. And so the income statement provides that information. Revenues less expenses equals income. You usually use the word net income, same thing, synonymous with profit. So is the company profitable? The balance sheet, and this income statement is, by the way, is over a period of time. Some statements will always have the amount of time at the top of the income statement. It could be for a month. Most of my businesses I was in, we did internal financial statements every month. But we did public financial statements every quarter because the Securities and Exchange Commission requires that of public companies. So the financial statements could be for a month, a quarter, or a year, and it's over a period of time. The balance sheet, on the other hand, is just a single point in time, the last day of whichever accounting period, the last day of the month, December 31st, the last day of the year. It's a snapshot. And then when we take that snapshot, we're going to, create a statement that shows here's all the assets, a list of all the assets and how much we own. We'll summarize them into some accounts, and that'll be on the left side. On the right side, we'll have the liabilities and the owner's equity. Guess what? They're going to equal. The assets will equal liabilities plus owner's equity on that. And that will help people look, okay, what are the things the company owns? Are those, good things? And then how much debt do they have? How much do they own? What's happening on the equity side? Is that growing or declining? And so the balance sheet is going to answer the question, what is the company's financial statement situation? Now, there's other statements, the cash flow statement. This is a supplemental schedule. It's really important, just as important as the income statement or balance sheet. And it just provides details on the cash inflows and outflows. Is the company generating cash? How's that company being used? Where's the company receiving cash from, debt or equity? So the cash flow statement, I see, very important. Statement of stockholders' equity shows us the changes in all the equity accounts. And then finally, footnotes. And these will just be 4 pages. And the footnotes can be 30 or 40 pages. And by the way, the footnotes are required disclosure. When we have the accounting rules, it's going to tell you how to record these things up here, and then how to report. It both tell you how to measure these things and how to report these things. Then it also will tell you what you have to disclose, which could provide a lot more detail than what you might see in the income statement. As an example, you might see one line item on the balance sheet that says long-term debt, and maybe it's 600 million, whatever. In the footnote, you will find all the tranches of that debt, the various components of that, and when it's going to come due. Is this 500-600 million? Is it due next year, or is it due in 10 years or 20 years? You'll find that in the footnote. And so, hey, the devil is in the details. This is a really true statement here. And so the footnotes are an integral part of the financial statements. And it gives you some assumptions, support, and details around the information in the financial statements. And, we're going to get close to the end here of this introductory income statement. And this is what we call a multi-step income statement. It's going to have some subtotals along the way. Revenues, less cost of sales. That's the, our products or service we sell. The cost of those direct things, expenses, directly related to the revenues. And we get that, we get to see gross margin. And a high gross margin percent tells us that, man, what we're buying, we're selling for a lot more. Why would a company have a high gross margin percent? Well, it could have a great brand and they're able to sell their products at a higher price. Think Apple. I could not imagine, even 5 years ago, how much I'm paying for an iPhone now. It's crazy, crazy. Well over $1,000 for some of the newer models. It's crazy. And then if we subtract in the operating expenses, usually we call that SG&A, or selling, general, and administrative expenses, we get to operating income. And these are more things like salaries for our leadership team, our overhead, our marketing staff, our accounting staff. And so we call that, you do refer to this as kind of business overhead. It's more indirectly related to the revenues. We still need these things because we wouldn't have a business if we didn't have administrative staff and promotional things in the selling part of that SG&A. And so that's important. This is another subtotal. Operating income, sometimes earnings before income taxes, EBIT. A lot of finance professionals like that term. And then we have other expenses, interest expenses and tax, and we get to net income. Now, for a public company with shares, common stock shares, we'll take net income divided by shares outstanding, and we will see earnings per share, EPS, on the income statement. And that's really important because if it's a public company, I can look at the price of the stock divided by the income per share of the stock. So if I'm thinking as a finance person, about whether this stock is undervalued or overvalued, I can look at that ratio called the price to the earnings ratio, PE ratio. And a higher PE ratio than the average for all stocks would say, hey, that stock is selling at a premium. Or if it's a lower PE ratio, I could say it's selling at a discount. So there's a lot of evaluation analysis and critical thinking that you can utilize once you understand the income statement and how these things relate. Another one people like to look at is net income divided by revenues. What's the percent return on revenues, or operating income? That's a really big one for percent. What percent of revenues that is? I remember for many of my businesses, I was the CFO the business up in Vermont. I wanted to get to 10%, or around 3 to 4%. And I really felt the rest of the industry was more like at 10 to 12%. And I pushed hard to try to help us get to 10% and either cut costs or develop products and brands that get to a higher price. There's a lot of different levers you can pull, but just think about all the things you can see in an income statement that can help you internally as a business person make strategic decisions, or externally looking at the statement, say whether I want to invest in the company or not. And here's kind of a balance sheet that we've talked about, all the things we own. We break it out to current assets. These are things that will turn into cash in the next year. Cash, accounts receivable, inventory, prepaid expense. You'll see that later in the course. And then things that are going to benefit us longer than a year, property, plant, and equipment. We may be using that for a long time, goodwill, and tangible assets. So these are everything we own. And on the right side, the claims against that. And the liabilities, we have current liabilities, things that we're going to have to pay in the next year. Look at that right off the bat. Let's make a judgment. How can we use this information to look at solvency? If the current assets are greater than the current liabilities, meaning these things are going to turn into cash in the next year, and these are things that we owe that we're going to pay cash in the next year. If these current assets are greater than current liabilities, hey, we have liquidity as a company. So that's a judgment that you can make as an investor, because a company could be making a lot of money, but yet have a liquidity crisis for whatever reason. And maybe they're not collecting all these receivables from their revenues, and maybe they have too much inventory. They bought too much inventory that's not selling. That's a really terrible situation. And so all that. And then we have long-term liabilities, things that are due greater than a year. Again, long-term solvency. You want to look at this long-term debt. How large is it? Is it overwhelming? Because if it's overwhelming, maybe the company's doing good in the short term, but it's going to have problems in the long term, especially as a prospective employee, because companies with really big high debt loads, big long-term debt, overwhelming this balance sheet, they've got big interest payments they're going to have to pay. If they don't pay it, they go bankrupt. So what do? They're going to be cutting costs to make it. And when they cut costs, they may not do wage increases or do restructurings and take people out of the business. So, again, if you can, you want to be able to look at these financial statements. And then finally, owner's equity, stock, retained earnings, accumulated other comprehensive income. We will get into that in intermediate accounting, and definitely in intermediate accounting too. We're going to talk about treasury stock. But this is simple here. Total assets, things we own, equal liabilities plus owner's equity. So this balance sheet, that's our reporting mechanism, is this financial statement, and it's going to answer the question, as you can see in some of my examples, around solvency. So, well, that's it for my introduction to all my videos. And again, please email me if you are enjoying these, and then maybe we can connect through LinkedIn or other means. And this is my son, Michael. He's now at Texas A&M studying accounting himself, and that eagle is definitely photoshopped in. But this happens to be not in Texas, as you can see all the trees and everything. This is in Vermont. This is overlooking. It's in Stowe, Vermont, overlooking some of the mountains of Vermont. Very beautiful spot. And so with that, I thank you for watching this and my introduction. And I do hope these videos will provide value for you. I try to keep things simple, bring it down to kind of layman's terms. That's the way I teach. And when I work problems, I do, there's a lot of redundancy in my problems because for my students, I feel like doing the accounting 2 or 3 times, same problem 2 or 3 times, and I get test you on it. In that redundancy, you'll learn. Because some of these accounting topics, you don't really know it from the textbook is so important. You don't know how much I stress reading the textbook to get these concepts down. But eventually, working the problems internalizes that and practices that. And you see it in reality. And it's sometimes, for me, beautiful to see how the accounting balances out and all the debits and credits work together in our accounting to be able to report. And I would say, why do I love accounting? I love the fact that we are doing a service for people who might be using these financial statements. And I was a chief accounting officer for 2 public companies over a 15-year period. And so I was doing what's called 10Qs every quarter, and 10Ks at the end of the year, 100-page plus document that was published to the Securities and Exchange, filed with the Securities Exchange Commission, who they published it. And we also published those financial statements on our website. And I took it, it was personal to me to make sure this information is not misleading, that it's relevant to the users, and that it had what we call faithful representation and reflected the reality of what's happening in the business, so the numbers, the reflection on those business transactions. And that, I don't know, I did really enjoy that, providing that service to users who I didn't really know who they were at times. And just like here on YouTube, I don't know who you guys are, and I would love to connect if we can, and if you enjoy these for sure. So with that, I thank you, and I hope that you get a chance to watch these videos. But I love that, and if it's helpful to you, I really love that. So thank you guys.